And we are live. What's going on, everyone? Thank you for joining the second episode of the Multifamily Methods podcast. It's been a interesting week. I saw a post last week about Brandon Turner losing $15 million of investor funds. I have been hearing about a lot of people going through a difficult period as an investor because interest rates have gone up so much in such a short period of time. So I've really taken the week to really assess my portfolio and go through a lot of different scenarios in my head to prevent this from ever happening to me. I like to call myself a paranoid entrepreneur. If you want to make a lot of money, I recommend that you be a paranoid entrepreneur. Although I don't recommend this for your happiness. But basically, you're always thinking about what could go wrong. And the best entrepreneurs that I know are always thinking about what can go wrong. And as a real estate investor, there's a lot that can go wrong. So what's happening today is very different from what happened in 2008. For those of you who don't know the cause of 2008, it started with the Federal Reserve. And a lot of people skip that part. A lot of people go straight to the fraud and abuse and the lending practices that took place. And they say that that's the reason for the 2008 recession. And they're right. But the root of it all started with the Fed. It started with the Federal Reserve keeping interest rates artificially low. And when interest rates became artificially low, there was a mania of, investment and, borrowing of money and putting that money into assets. And that's what happens. That's actually also what happened during the Roaring 20s that led into the Great Depression in the 1930s. It actually started with the Fed keeping interest rates artificially low. And the Fed started in 1913. So it was very shortly after 1913 when the Federal Reserve actually started that we kept interest rates artificially low. We had the Roaring 20s. The Roaring 20s was a big bubble. There was a lot of speculative investment, and it ended up in the Great Depression in the early 30s. So we had a lot of the same in 2008. Interest rates were artificially low. As a result of all of the bullish sentiment in the stock market and particularly in real estate, a lot of lenders really started to do fraudulent practices and really approve anyone who could fog a mirror. And the subprime market started growing. It became very popular. Subprime is people with bad credit scores and people who don't qualify for your typical mortgage. And the credit agencies were ranking these subprime mortgages as A and AAA ratings. So the whole thing was a fraud. They were approving absolutely anyone. They were rating these loans as safe. And then, basically the whole thing came collapsing down. It started with subprime, and then went into, basically all of real estate in 2008. And then, real estate prices came crashing down as people basically handed their keys as they were upside down on their mortgage. Obviously the subprime market couldn't afford their mortgages anymore because they shouldn't have been approved for those loans in the first place. And so 2008 became a big fat mess. People who shouldn't have qualified for these loans to begin with qualified for them. And then the whole thing came crashing down. 2026 is very different from what happened in 2008. Lending practices are a lot more strict. There's more regulation. we do not have the same issues in terms of people getting approved for loans who shouldn't have been approved for loans in the first place. We don't have nearly as much of that in 2026. But we still have the same root of the issue, which is the Federal Reserve keeping interest rates artificially low. So during the COVID era, we had, people were out their jobs, people couldn't go to work. The Fed had interest rates, basically the Fed funds rate was at 0%. So you could get a mortgage for 3.5%. There was a bunch of quantitative easing that resulted in some very high inflation, as we all know. But once again, the Fed kept interest rates artificially low, and you could get a mortgage at 3%. I've heard some people as low as 2.9% with a 30-year mortgage. So now we have an issue in the housing market. First of all, no one wants to sell their home because their interest rates are already 3%. That's a very valuable asset. That debt is a very valuable asset if you're an investor. Why would you want to sell a 3% mortgage just to get a 7% mortgage? That doesn't make any sense. So no one wants to sell their homes, and so there's a lot less volume, a lot less activity in the market. But what happened to Brandon Turner and what's happening to a lot of investors today is when you're in residential real estate, you can get 15 or 30 year fixed rate debt. So long-term fixed rate debt, which means I can buy the property today, and for the next 30 years, my interest rate is not going to change. It's going to stay fixed for the entire 30 years. So it doesn't matter what happens to the economy. It doesn't matter what happens to interest rates. I'm going to stay at the same interest rate all 30 years. And that could be extremely powerful as an investor because, as inflation gets worse, a lot of people think of inflation as a benefit for investors because of the appreciation that we realize as investors. And that's absolutely true. But even more so than that, it is the depletion or the evisceration of the value of that mortgage. So if you have a $200,000 mortgage, if inflation gets worse and worse over 10 years or 20 years, and wages increase and rents increase, it becomes a lot easier to pay back that $200,000. So a $200,000 mortgage in 2026 is a lot more money than a $200,000 mortgage in 2056 or 2046. And so the value of that debt depletes over time. So that's a massive benefit that we get as real estate investors if you're willing to hold on to the mortgage long term. Now, on the commercial side, you don't get that benefit unless you are doing HUD or agency debt. If you get a commercial loan, which is what a lot of real estate, that's a lot of what real estate investors get for their financing for multifamily properties, apartments, office space, etc., you don't get 30-year fixed rate debt. And let me clarify something. Even with agency debt, you get an amortization of 30 years, but it's only fixed for 10 years tops. You still don't get that 30-year fixed rate debt even with agency debt, which is Fannie and Freddie financing. But if you get a commercial loan, the most standard types of loans for commercial loans is a 3-year or a 5-year balloon. So you're either going to get a balloon after 5 years, which means your interest rate is fixed, but after 5 years, you have to pay that loan back. And you do that with either a sale or a refinance. Unless, you're listening to this and you got millions of dollars in your bank account. I sure don't, and I know most people don't. So if you don't, you sell or refinance at the end of your term. If you have an ARM or an adjustable rate mortgage, then the only difference is after those 5 years, that interest rate adjusts. And that amortization or that loan term is going to be over 20 years. So if you have a 5-year balloon amortized over 20 years, then you get 5 years of that loan, you refinance, and then you get another 5 years for that loan, you refinance again, and you do that 4 times over, a period of 20 years until that loan is paid off. So what happened to Brandon Turner is he got a 5-year loan, as most investors do, when interest rates were artificially low. And 5 years later, we know what happened from, the COVID era up until, a year and a half ago or so, where interest rates just went up very quickly at an unprecedented rate, at an unprecedented speed. And so interest rates went from roughly 3% to roughly 7%, 7.5%. I had some commercial loans that were even as high as 8%. And so what happens is that in multifamily, the valuation is based on cap rate and NOI, the income. And the cap rate is essentially, you can think of it as a trading multiple for your property. So your NOI divided by your purchase price equals your cap rate. And as interest rates increase, purchasing power decreases. And so cap rates follow interest rates. And that's inversely true. And this is most of the time. Sometimes they could be inversely correlated as well. But most of the time, if interest rates come down, purchasing power increases and cap rates go down. The only time that might not work out is if you have interest rates come down. And again, this is why the Fed keeping interest rates artificially low gets kind of in the way of things. A lot of people don't want to sell their property because they have that low interest rate. So if you see a decrease in interest rates, you might see an increase in supply as more homeowners now decide to sell their home because they can get that lower interest rate that they already have. And so that increase in supply may affect pricing. But most of the time, interest rates come down, cap rates follow, and vice versa. And when cap rates go up, values go down. When cap rates go down, values go up. Okay? So he had a 3% interest rate. Over the span of his 5-year loan, he had a 7% interest rate. And so his cap rates essentially doubled, which means his value essentially cut in half. Or he had a very substantial decrease in value. And so at the end of those 5 years, when he went to refinance, the lender said, well, wait a minute. Your collateral, your property, has now decreased substantially in value. And so your loan amount is now higher than the property value. Or it's not at a 70% or 75% loan to value, whatever his requirement was. And so he had to bring 8 figures, like over $10 million of investor capital in order to keep this deal alive because the value had decreased so substantially. And could he have predicted this? Or I should say this differently. Could he have underwritten this and said, wait a second, interest rates have been artificially low? People think today, prime is 6.75%. People say today that interest rates are high. Historically, they're not high. They're not high at all. They're just high in comparison to what they were during the COVID era when rates were literally historically low. But historically, rates are not high. Rates are actually quite low historically. So a prudent thing to do would have been to, in hindsight, in retrospect, would have been to look at interest rates over the past 50 years and say, okay, 3% for a mortgage is historically low. We've never had interest rates this low. So if I take what interest rates have been on average over the past 50 years, if interest rates increase to this level, basically stress testing, can this deal weather that storm? Nobody did that, or at least 90% of investors did not do that. It was only the very seasoned investors who looked around and saw this mania, all these people paying way too much money, everyone getting into syndications. So no one underwrote it like that. And, therefore, a lot of people are starting to get into trouble as their 5-year or their 3-year loans are starting to mature. Interest rates are a lot higher, cap rates are a lot higher, and so property values are declining. And so that, in a nutshell, is what happened to Brandon Turner. That's what's happening to a lot of investors. And so I hear that, I read about that, I listen about that, and my brain immediately goes to, how can I prevent this from ever happening to me? I'm fortunate for a few reasons. Number one, I invest in the Midwest, in St. Louis. And so interest rates affect the Midwest far less than they do in appreciation markets like Texas, Florida. Brandon's deal was in Texas. Texas, Florida, New York, California, Arizona. St. Louis is a much more boring, linear market, 3 to 5% appreciation on average per year. Don't see the major ups and downs. So being in the Midwest protects me from that to a certain extent. Also, a lot of the properties that I purchase, particularly the apartment deals, which is where the 3 to 5 year terms exist, I purchased when rates were already high. So I underwrote those deals at 7 and 8% interest rates. And so I might even get the inverse benefit if rates continue to go down, which we'll see if that happens with the new Fed chair, Kevin Warsh. We'll see what he does. He certainly is going to have political pressure from Trump, but we have massive inflation, and so it's going to be difficult to justify a major decline in interest rates. But we also have recession risk, so it's going to be difficult not to justify it. The Fed's in a little bit of a pickle. So it will be interesting to see what happens with interest rates. But I might get the inverse benefit if interest rates come down and I underwrote it at a 7 and 8% interest rate and they end up at 6.5%, for example. So if you're watching this and you're having the same thoughts I did, which is how do I prevent this from ever happening where I lose property, lose investment capital or whatever it is. Number one, only get into the raising money business if you have very high stress tolerance and you have the stomach to lose money, or the stomach to overcome trials and tribulations like this. The goal should never be to lose money. That's over communicating with your partners, being solution oriented, not putting the blame on other people. That is incredibly important if you want to raise money and get into large deals. So that's mindset, character traits. From a more practical perspective, make sure you have a substantial amount of reserves. Liquidity, everyone has a great plan until they get smacked in the face. Everyone has a plan until they get punched in the face, Mike Tyson. Liquidity solves all. So you could be mega rich on paper. You could have a very high net worth on paper. But if you don't have liquidity, you could lose all of that. And so have lots of liquidity, lots of reserves, not in the stock market, not in real estate, not in anything, but in cash or T-bills or something that is liquid. So that's number one, have substantial liquidity. Number two, the more you can pivot your financing to long-term fixed rate debt, the better. So If you could get agency debt that is fixed for 10 years, that's going to be better than a 5 or 3 year balloon. And a 5 year balloon is going to be most of the time better than a 3 year balloon. Because if you can get a longer term fixed rate debt, your principal pay down is going to be more and more substantial. And so if I have a 20-year loan and I pay down that note for 10 years, even if interest rates go up, I could refinance that and increase my amortization. Increasing my amortization is going to decrease my loan. So even if interest rates increase a little bit, I might be able to even that out depending on how much principal I have paid down. And then also, just longer term debt just protects you from interest rate hikes. So if Brandon had a 10-year term rather than a 5-year term, he would still have 5 more years to raise money, or maybe interest rates go at least a little bit lower than they are today, or something. You would be able to have more time to plan if you have that longer term fixed rate debt. And then for me personally, a third one is invest in your backyard and have in-house operations. So I know Brandon invested out of state for this deal. There's a lot of operators that successfully invest out of state. I've invested out of state, so I don't want to knock against anyone who invests out of state, because I do believe that you can do it. You need to be more hands-on than you think, more hands-on than you hear in the podcasts or read in the books. But if the deal is literally in your backyard, you can go there whenever there are issues, whenever you're needed. If you need to look at the property for whatever reason, it's easier to kind of manage your team if you're boots on the ground. So I'm a firm believer, all 450 of my units are within a 30-minute radius. And that helps me a lot. Economies of scale. I can do my maintenance requests a lot easier. I know literally by the street where all of my properties are. I know the areas like the back of my hand. So that really, really helps. But anyways, that's what happened. That's what's happening to a lot of investors. That's how you can protect yourself. For me personally, I am most focused in 2026 on my active income businesses. I'm not so much focused on growing my rental portfolio. I'm buying deals here and there. Bought a 10 unit. I've bought several duplexes, single family homes, but I'm not going to double in size like I did last year. My main focus for this year is, I have my construction business, education, my lending business, and my property management business. I really want to focus on making all of those as profitable as I can. Really refining my systems, taking myself outside of those businesses. I'm hiring on a head property manager to manage my property management staff in July, which I'm really excited about. So just making moves like that, focusing on my active income businesses to increase my cash reserve, increase my liquidity, and increase my cash flow. That to me is far more important, because owning 100 more units or 200 more units really is not going to change my lifestyle all that much, but increasing my cash substantially by tens of thousands of dollars every month is going to change my lifestyle. And especially if I can turn that into more liquidity and more savings, that's going to give me more peace of mind, and it is going to give me a far lower risk of losing everything in the long term. So that's what I'm focusing on. If you've been growing your portfolio aggressively, I think right now is a very good time to focus on your liquidity, pivot into focusing on active income. If not, if you're in the growth phase, go for it. I've been there. That is the most enjoyable season as a real estate investor. Be aggressive, but don't be reckless. Make sure those numbers work out. I assure you, it is far more worth it to go slowly than it is to go too fast and get yourself into trouble, or even to get yourself into a very stressful fight or flight state. That's what I did to myself the first 5 years that I was in business, and I do not recommend it. But anyways, guys, that is it for today. Thank you for listening to the Multifamily Methods podcast, and we will see you next time.